Hello guys, so it's another video again on Valhalla Trades channel. We are still on the series about why SLP fails, and in today's subject we'll be talking about how liquidity contributes to why SLP fails. So let's dive in and see how liquidity truly contributes to why SLP fails. So starting from a standpoint of view, which is the directional bias, you see that for every move we have an impulsive move and a correctional move. We have an impulsive move and a correctional move. Then, in the instances, we've talked about major type of liquidity. So, the single candle inducement, probably, let me just print it out. The single candle inducement, which is this candle here, is the inducement most LSLP traders tend to use. But there are rules and there are certain times when a single candle inducement does not apply to a trade. Now, when you're taking an impulsive move, you want to use a full retracement inducement. And what I mean by a full retracement inducement is that after every break of structure or after every market structure shift, what we look for next are our PIs. Then after our PIs, we look for our liquidity points. So this is an instance here. Price came into a weekly time frame breaker block. If we go back to it, we're going to see that price was reacting off a weekly breaker block. So when price came into the weekly breaker block, we expected price to give us an MSS on a lower time frame. Then we take our trade because it's continuing lower. So this is the weekly time frame breaker block. Price came into it. So when price came into the weekly time frame breaker block, we moved below to the lower time frame to look for entries. So when it got there, then now we'll be looking for an MSS, that is a market structure shift, so we could take the move downward. But in this type of scenario, like I said earlier, when price is making an impulsive move, you want to use a full retracement inducement, not a single candle inducement. A full retracement inducement, not a single candle inducement. Because, and especially when price is reacting off a higher time frame, like the daily or the weekly, maybe it's another block or a key level, whatever it is. If price is reacting off that level and you want to take the move downwards to a much deeper place, you want to focus on a full retracement inducement other than a single candle inducement. So starting from this point here out, price did an MSS at this point. Note, you are reacting off a high time frame PI. So now we're looking for sales downward. If you have taken this this particular single candle, and where would be your now you'd have used this breaker block because that's obviously the last PI before, and breaker blocks are failed zones in the market, failed order block. So where will be your loss? Your loss will be just above the point of interest. Now, this is why a lot of people, and you see that price is going to trigger you in, then give you a stop loss before going to the intended direction. So it has contributed a lot to the many losses. And for us SLP traders, we prioritize on having a lower risks, a lower stop loss, and a higher take profit target because it increases our chance. Our strategy is a low win rate strategy. You don't have high win rates when you're trading SLP, so you have to focus on getting a tight stop loss as possible, so for you to maximize your returns in the long term. So, but if you could focus on an inducement candle, full retracement inducement candle, especially when price is reacting off a higher time period key level, you are going to increase your win rates. And I'm also going to make a video on how to increase your win rate. We'll talk about major aspects. But for now, this 4-part series, we've talked about market structure, we've talked about point of interest. Now we are dealing with liquidity. The next is going to be the psychology part and a little touch about directional bias also. Today's video will not be long, so keep it simple. So, like I said, if price is reacting off a high time frame key level, you want to focus on a full retracement inducement. And a full retracement inducement is this, that price costs a break, either a break of structure or an MSS, then pulled back, retraced not with a single candle, but with a series of candles, then proceeds to now take out the body or whatever it is you want to take out. But the idea is that price should give a full retracement, a full pullback inside. And what you see is that this pullback now has mitigated every point of interest that was left here. So the remaining point of interest that was left for price to take was the order block above, and price came into that order block and sold downward. You see, so if you have waited for this trade, you would have even gotten a much higher risk to reward than the one you took from this position here. You see now. So whenever price gives a single candle inducement on a higher time frame point of interest, be careful of it. Most likely, price will likely take that single candle inducement out, give out a full retracement inducement, and then look for the extreme PI. Most of the time, price goes to the extreme PI, especially for an impulsive move. If you are trading a correctional move, that's another different story. For a correctional move, you could use a single candle, and you could also use a breaker block. But if you are trading an impulsive move, now this is a correctional move here. Note, if you go back to this point, yeah, when price wanted to do, you could also see it went back into a point of interest lower. But there's a trade I put on silver. There's a silver trade months ago when price made the first low. Let me zoom out a bit. Okay, this was it here. You see that it was an impulsive move. Price was making an impulsive, price made an impulse, then gave a correctional move. So the correctional move, you could use a single candle inducement and a breaker block as your entry when price wants to switch trend. So you see an impulsive move, a correctional move, then a continuous impulsive move downward. That's just the idea. So when we wanted to trade this correctional move here, to take the position higher, you could see that price form and MSS made use of an inducement, single candle inducement here, pulled out into a breaker block, and pulled out into a breaker block and went upward. But most times, this is not going to work for an impulsive move, which is this leg here, this particular leg here. It may likely not work most times, because an impulsive move is another theory apart from a correctional move. So be careful of what you trade using an impulsive move and what you trade using a correctional move. If you want to trade an impulsive move, wait for price to pull into the extreme. It's much better. But for a correctional move now, you could use a single candle inducement. But the idea is that liquidity, single candle inducement, and the full retracement candle inducement is one of the key factors that contributes to why people say SLP fails nowadays. Because most traders just come to their chart, then they mark random zones, see a single candle, take the single candle, and the instance is that they're not targeting the recent low. If they're even targeting the most recent low, yeah, but they will be targeting a higher time frame low or a higher time frame high, a higher time frame liquidity exit point, so that they could take their profit there. And most times, you are actually trading the inducement move. So you are trading the inducement when the inducement move is forming. What I mean is this: you are trading a move that was meant for the inducement to form. I think I saw similar stuff on gold, yeah, last week. By the time I post this video, it's obviously going to be already a week over. So this is it. You are you are trading the inducement move. This is it. Price pulled in, form a single candle or whatever, pulled into it. So now on a higher time frame point of view, this is an inducement above here. So price will pull into this zone, may likely pull into this zone. But you taking this zone here, you are trading it. Then what? If you are targeting in a higher time frame point of view, it may likely be this low here. That is for swing traders, obviously. So what if price comes here and you do not take profit? Maybe you're the type of guy that say, okay, it's either TP or SL, and you don't take profit here. Price may reverse to your entry, take you out at your stop loss, then tap the intended PI before now moving downward. So this is why liquidity contributes to how SLP fails. So see you in the next video. We'll be talking about the psychology aspect of why SLP fails. So bye for now. Thank you.